maintain the decorum of the session throughout. As the new modern times, it is important to develop vital skills to sustain and survive in this competitive world. One of the most important skills is to develop the habit of saving. But saving money is not enough. You need to find out some investment options wherein your money grow as well. And as we all know, what would be a greater option than mutual funds? So, keeping this in mind, we have arranged today's seminar. The topic for today's seminar is mutual funds for new age investors. So, today we have with us Mr. Yogesh Narvekar sir. Sir's journey is an example of hard work and passion. He worked for 20 years in the field of engineering, and later on he developed his passion in the field of personal finance, and that's how the Phoenix Financial Services was born. As we all know, success begins with hard work, passion, dedication, and consistency. Sir's relentless hard work and persistence of more than 6 years has made Phoenix a great success. Phoenix Financial Services is a professional solution provider in the field of personal financial consulting. The Phoenix Company provides advice in the areas such as insurance planning, investment planning, mutual funds, PMF, estate planning, and many more. Phoenix aims to help their clients to manage financial resources and achieve financial well-being. About 6 years of experience and 75 award wins. At present, Phoenix is serving more than 350 happy families, and the number is increasing by day. Now, without keeping you all awaiting, I would request Sir to begin with our today's seminar.
Thank you, Amruta. Thank you for this wonderful introduction. And I appreciate patience of all the participants. It was to start at 10 o'clock, but due to some glitches, we are starting it at 10:30, but better late than never. So actually I was trying to chat and I was trying to know what is the type of group that we are having now. Whether there are most of the people who have already started investing into mutual funds or stocks, or it is entirely a new subject for all of you. But looking at the responses which I have received, I think very hardly few students are right now have started investing into mutual funds or stocks directly. For those who have not yet started the investing, but they must be reading into the newspapers and print and TV media that how the stock market is behaving or performing in the last 1 or 2 years, especially after the advent of coronavirus and the pandemic. In March 20, suddenly the stock market came down from some 42,000 level to 26,000 level. It was a big fall of around 40%. Many of the investors lost their money not because of the market fall, but because of seeing their investment going down 40 to 50% from the investment value. So that was a big jolt to them, and they suddenly exited without any reasons. And but how the market was, that you must have seen from the low of 26,000 in March 20. Now we are sitting at around 57,000 level of the Sensex. So it is more than almost 100% or 120% growth. Even in month of October 21, it had reached 62,000 level. From there, it has come down again, and it is hovering in the range of 57,000. So you can see the journey from 42, it came down to 26. From 26, suddenly when there was a least expectation of sudden recovery, it went to 62,000 within 1.5 year, and now it is again in the range of 55 to 60,000. So it is a very topsy-turvy round, or maybe you can say exciting journey, but at the same time you need to be patient enough to survive into this journey. So I'll begin my presentation with a small quote, and then we will move on to the mutual funds. 1 minute, let me share my screen now. Amruta, in between I may not be able to see the messages from the participants. So if there any query or clarification on any of the slides or any of the point, you just let me know so that we can answer it there itself.
Okay, sir, fine.
I want it to be an interactive session so that it is not a one-way, like a lecture kind of thing. It shouldn't happen. I will come to know anyways. Right now, I am seeing around 82 participants are there. I hope by end of it, the number remains same. Okay, one
Yes,
minute.
sir.
Can you see the screen?
Yes, sir, it's visible.
It's
Yes, sir.
visible. It is. Yeah. Welcome to the seminar guest lecture on mutual funds for new age investors. So that is what I said. I will start with a quote. That is, unless it is the quote is by one of the famous investors, or rather one of the richest or the richest man in the world, Warren Buffett. What he has said: unless you can watch your investment portfolio decline by 50% without becoming panic-stricken, you should not be in the stock market. So what does it mean? In stock market or in mutual funds, we will come to know how the mutual fund invests into stock market. It invests into stock market, so it is not a one-way journey. It is not. People have come to know of stock market because of the returns that it is generating, but that returns are not in linear fashion. It goes up, it comes down, but in the long run, it will definitely give you good returns. But for that, when it goes down, you should be ready to see your notional value of the investment going down. Then only you can enjoy the fruits of it becoming double or triple or 4 times or 10 times. So that is where what he is saying, that you just keep in mind that you should be ready to see your investment going down. It will happen in initial part of your investment journey, but you should not exit from your investment unless and until it is absolutely necessary, and you should hold on to it. Then only you can enjoy the fruits of your investments. So what we are going to see in today's seminar, I have touched upon what are the objectives, what is the basic of mutual fund. For those who don't know at all about anything about mutual fund, I'll tell you how does the mutual fund works, what are the different categories of mutual funds, how each fund in different category is suitable for each and every need, how there are different funds which are suitable for different needs of the people. Then what are the risks and returns? What are the risks while investing into mutual fund, and what kind of returns you can expect from mutual fund in the long run? What are the different options in the mutual fund? When we say mutual funds, generally what comes to our mind is SIP, because a lot of marketing is going on about SIP, systematic investment plan. But apart from SIP, what are the other investment options into mutual funds that we will see? And the main famous focus is on SIP, systematic investment. What are its benefits? How it helps you build a corpus, and how it helps you satisfy your needs or goal-based planning. In that, how SIP helps you, that I will explain you. And then similarly, what are the additional features of mutual fund? How it helps you when the time on the basis of time horizon and compounding, that we will discuss in this seminar. So before going to the actual subject, I just wanted to touch upon the new age financial challenges. The subject, as we have decided, it is for mutual fund for new age investors. So what is this new age investors have the financial challenges? So now if you see on the left hand side, it was a previous generation, that may be a generation of my age and even before that. Earlier what used to happen, initial years of our life were going into studies, and that was around 18 to 20 years. People used to have their graduation, and then they used to work. And when they used to work, it was a normal 8 to 6 job, which they used to do it for next 42 years. From 18 to 20 till the age of 60, there was a long professional life in which they could earn the money, they could spend the money, they could save it, and save it in a substantial manner for the long period of time. And then there was a after retirement, there was a 15 years retirement life was there based on the life expectancy, which was around 70-75 years. So what you see, there were, if you see it, the study age was lesser, the retirement age was equal as good as a study age, and in between the earning age was a big span. It was around 40 to 42 years of earning span was there, which was helping you live a peaceful retirement life. Okay, but come to this generation, rather your generation, what is happening right now? Nobody stops at graduation. Even after completing the graduation, everybody wants to go for post graduation for higher studies. Sometimes it happens immediately. Once you complete the graduation at the age of 2021, some students directly take admission for the MBA and they complete it at the age of maybe 23-24. But sometimes if you don't get admission immediately, you serve in a company, or you go or do a profession, you do a work at some company for maybe 1 or 2 years, you prepare for your exams, and then you again apply for the management examination, or maybe you go for higher studies abroad. So what is happening? The study life has gone up from 18 to 20 to 25 years. Similarly, because of the work pressures, nobody wants to work till 60. You must have seen around yourself, there are many people who are exhausted because of the work pressure. People are working from morning 8 o'clock till 8:30, even 10 o'clock. Because of this working from home funda, there is no escape from the what do you say, professional life. Earlier, people, when they used to leave the office at 6 o'clock or 8 o'clock, they used to come home and they used to spend time with the family. But that is not the case right now, because you are always connected. You are always connected, you are at home. Because of that, there are a lot of working pressures on the people, and people don't want to work till 60. People want to retire early at maybe 50, 60. So that has reduced the working lifespan. It has come to around 25 to 30 years. And then because of the medical advancement, the retirement life has increased. So earlier the life expectancy was around 75, now it has gone up to 80. Because of that, what has happened? The retirement life, the passive income life has lifespan has increased. So your working life has reduced, your study life has increased, and your retirement life has increased. So the period available to you to build your corpus, or to satisfy your dreams, to invest for your future goals, that period has reduced. So you need to invest aggressively. You need to invest in a proper planned way if you want to achieve those goals. Otherwise, it might happen your working life will have to be extended. It cannot happen that you can stop at the age of 50 or 55, because your needs won't get completed or achieved. So that you need to keep in mind, and then plan your finances accordingly. So coming to mutual funds, do you remember the famous line of mutual fund? If you see earlier, whenever there was any ad of mutual fund, it used to end with a quote: "Mutual fund investments are subject to market risk. Please read the offer documents carefully before investing." Isn't it? So all of you must have heard this line before, and it used to create a fear in people's mind, because nowhere else you must have seen this line, or you must have heard this line. Have you heard this line while buying an insurance policy, or have you heard this line while buying a bank with fixed deposit, or whenever you go to a post office? Nobody tells you the post office investments are subject to risk and please read the document carefully. It doesn't happen. But in mutual funds, this line always comes at the end of any promotional video or audio, and that was creating a little bit of fear in the investor's mind. But due to sustained efforts from the AMFI, or the professional body which is handling all the mutual funds, now how do you understand the mutual funds? Mutual fund sahi hai, isn't it? You must have heard many advertisements. Mutual fund sahi hai. Nowadays, you get to see Mahendra Singh Dhoni, Sachin Tendulkar, or other many cricketers have started promoting the mutual fund. Mutual fund sahi hai. And then there are different types of advertisements are there. which are explaining you the types of mutual funds and all, what are the nitty-gritties of the mutual funds. So that's the whole change of paradigm. So earlier it was a subject to market risk and people used to stay away from it. But in last 2-3 years, it has suddenly the people focus and the way they used to look at the mutual fund has changed. And now they say people say mutual fund sahi hai. So what is mutual fund all about? So what is a mutual fund? I'll just try to explain with a simple image, and then we will go into detail. So you see a plane over here. It is an Indigo Airlines ka plane, and there is a passenger and pilot. That is what is mentioned over here. So I'll try to explain you with a simple analogy. There are around 80-85 participants are there, and just assume that we decide to go to Delhi. All of us want to go to Delhi. So what we will do? We will go to an airlines office. We will hire we will buy a ticket. All of us will buy maybe we will do a group booking, because our common goal is to go to Delhi to attend maybe a afternoon seminar. So our goal is decided that we want to go to Delhi at around 12 noon today to attend a seminar at 4 o'clock. If we want to go alone, it might be very difficult, because then we will have to have a charter flight. It will cost a lot and may not be available. But we know there are many flights are going to Mumbai, Delhi. A lot of flights are there on this route. And we found out that around maybe 11 o'clock or 12 noon, there is a flight which is just right in price. And it has got available seats of around 80-85. And Indigo ka performance is also good, the on-time arrival. So, and the ticket is also very reasonable. So what we do, we buy tickets, we sit in a plane, and there is a professional pilot who knows the route, who knows the driving, and he takes all of us from Mumbai to Delhi in 2 hours. Do we need to bother about how the weather will be? Perhaps no. Do we need to bother about how to drive the plane, or at what height we need to go, and whether to buy a 4-engine flight or a 2-engine flight will do? Did we find out that? No. What we did, we knew that we want to go from Mumbai to Delhi. We found out the airlines. There was airlines. We found out the ticket which was reasonable. We booked it. We sat peacefully in the plane, maybe reading newspapers or articles, and the plane safely landed us at Delhi airport, and we went to attend the seminar. So this is nothing but a mutual fund. What does mutual fund do? I'll show you with the image again. There are investors.
Sir, I'm sorry to interrupt, but can you please click the hide button there? It is downside.
Yeah, this?
Yes, yes.
Yeah, okay.
Thank you.
So, so there are investors, lot of investors, around 85. Same way, there are around 80-85 investors are there. They want to invest into stocks. They want to invest into stocks, but they don't have the knowledge of which company to buy, which company is doing good vis-a-vis the other company. The comparison they can't do. So what they do, they have a money, so they pull in their money with a fund manager, which is equivalent to maybe a pilot. That fund manager has got a team of risk analysts who are studying the stock market companies, the listed companies in the stock market, and they are shortlisting the companies which are doing consistently good. So investor pull their money with the fund manager, then the fund manager invest that money into securities. Those securities could be, if it is an equity mutual fund, those securities will be stocks of the different companies. If it is a debt mutual fund, those could be commercial papers or government papers, bonds. So that money taken from the investors is invested by fund manager into the consistent performing or good performing securities. Those securities perform over a period of time and they generate the returns. When there is an appreciation in the underlying stocks, that appreciation is reflected into the valuation of the mutual funds, and then those returns are passed back to the investors. So you, for example, you invested 100 rupees. Like that, there are other 10 people. So together we invested 1000 rupees. With that 1000 rupees, the fund manager will buy around 10 to 15 companies ka stocks, proportionate basis. When those companies ka stocks will perform over a period of time, maybe that 1000 rupees will become 1500, and that appreciation of 500 rupees will be passed back to the investors. That will reflect in their mutual fund units ka valuation. So your individual valuation of 100 rupee will show it as 150 rupees. So there might be a 50 rupees ka appreciation in your investment ka value. The only thing is that 100 to become 150 or 200, that doesn't happen in a linear fashion. There might be a period in your investment journey when that 100 might become 80 or 90, or it even might become 50. But as I explained you earlier, it is only a notional. You only get to see the valuation of your investment going down to 50. Unless and until you sell it, there won't be any loss. So that we need to keep in mind. So the only definition I have just tried to write it down here, that what is a mutual fund? It is a trust that pools the savings of several investors who share a common financial goal. The money thus collected is then invested in the capital market instruments such as shares, debentures, other securities, and the income earned through these investments and the appreciation realized are shared by its unit holders in the proportion to the number of units owned by them. Thus, mutual fund is the most suitable investment for the common man, as it offers an opportunity to invest in a diversified, professionally managed basket of securities at a relatively low cost. So, as I was explaining, I was showing you a big jumbo airplane. So, what you will say then, if this plane is a mutual fund, then what is a stock? What is a stock market investment? If somebody is doing a stock market investment, so how it is different from traveling in a plane? Just to give a comparison, maybe directly buying in a stock is nothing but driving or flying your private jet. If you have the knowledge, if you have the expertise, if you have taken professional training for flying an airplane, for flying a private jet, then it is okay. Otherwise, it will only give you excitement, but there are high likely chances that you might crash land. So that is why, if your goal is defined that I want to go from one place to other, then it is better to hire a jet and go peacefully over there. It need not be that you yourself need to drive it. Of course, you can do it, but for that you need to have a professional training, knowledge, understanding of how does it work actually. If that is not there, then the mutual fund is perhaps the best way for any retail investor. So now that we have understood what is mutual fund, then I will come to a next part of it, that is what are the mutual fund categorization. So I am just explaining you the broad classification. There are 5 types of categories are there. Simple is one is equity, which is investing only into the equity market. Then there is a debt, which is investing only into the debt market. Then, as the name suggests, hybrid. Hybrid is a mix of equity and debt. So there will be some part of equity will be there in those mutual fund schemes, as well as some part of debt will be there. Then the 4th type is solution oriented. What are those? I will explain you. And then the last part is other. So whatever is not fitting into these first 4 types, that is kept into the other part. So if we see equity mutual funds, then there are some 11 subtypes are there into equity mutual fund. Large cap, large and mid, small, multi cap, flexi cap. Can anybody of you right now there is a big new fund offer going on for one of the mutual funds? Have you come across it? Amruta, can I get any answers? Participant, just tell me, have you heard right now there is a big advertising campaign going on for one of the big fund houses. Their new fund is coming up in the market, and you must be seeing the ads on the TV, or you must have heard it on your even FM as well. Can any of you tell me? Hello, Amruta.
Yes, sir. Yeah, yes, sir.
Is there any answer?
No, sir. There are no answers in the chat box.
Oh, surprising. Haven't you heard of SBI Multi-Cap Fund?
Yes, sir.
Nowadays there are a lot of advertisement going on in the TV. If you are you were watching that T20 series, during that series as well, there was a advertisement for the SBI Multi-Cap Fund. I have heard it on quite a few number of FM channels as well. So SBI is coming up. SBI Mutual Fund is coming up with a new fund which is into a multi-cap category. So that way, in this way, there are many fund houses around. There are total 43 mutual fund houses are there, and each fund house has got a different mutual fund schemes into all these categories from equity. Similarly, like equity, there are around 16 categories are there into debt funds as well. Right now, as even starting from overnight funds to a floater fund. So I will explain you what is overnight, liquid, ultra and short duration in the next slide. Then there are hybrid funds. So hybrid fund is generally a mix of equity and debt. So if you see, as the name shows, it goes from conservative hybrid to aggressive hybrid to dynamic asset allocation, multi-asset. So what is multi-asset? It is investing into multiple asset classes like equity, debt, gold, real estate, etc. Arbitrage is there, equity savings is there. Then the famous solution-oriented funds are there, that is retirement and children education. So people invest, like to invest into any of the investment option if it has got a specific name against it. You must have heard as soon as a baby is born in a family, parents want to buy any child insurance policy for them. So similar way, there are mutual funds which are investing in, which are solution oriented, that is children gift fund kind of there. Then similarly, there is a retirement fund is there, which is specifically investing into the instruments suitable for your retirement needs. And then the last part is like equity mutual fund or debt mutual fund, there are funds for the gold as well. You can invest into gold through mutual funds. Then there are index fund. You must have heard new fund offers coming for index fund or exchange traded funds as well. And the last part of it is fund of funds. What is fund of funds? It is not a single fund, but it is investing into multiple funds. One fund is investing into 4 mutual funds. So that is called as fund of funds. Generally, these type of funds are available for investing into the foreign equity market. Recently, just 15 days back, there was a similar new fund offer from DSP Mutual Fund, which was a global innovation fund, which was investing into the foreign companies which are investing into global innovation. So DSP fund was a feeder fund for them. So in this I will explain you what is the type of equity funds, how they are categorized. When you want to invest into equity funds, sometimes like many of you might be, some of you might be investing into the stocks. So either some people start with a penny stock, the stock which is available at maybe 10 paise, 20 paise, or they go with the big companies or well-known companies like maybe Infosys or Reliance or TCS or L&T kind of thing. So what are these companies? These companies are large cap companies. So the first 100 companies by market cap size are called as large cap. And then the funds are there, mutual funds, which are investing into some of those companies are called as large cap funds. So this categorization is very specific. when you are investing into any large cap fund, it will only invest into the companies which are amongst the top 100 by market cap size. It won't divert and invest into some small stock. So when you are investing into large cap fund, you are very sure that though I am not aware of the stocks, which stocks to buy into those 100 companies, and I don't want to take any unnecessary risk by investing into the small companies, my fund will also do the same. The only difference is that if I go and buy stocks, I might favor the well-known companies or the companies which whose name I know. We may not know the performance of the companies. So that is why we are going to the mutual funds. We are going to a fund manager who is investing into large cap funds. So he will identify from those 100 companies, he will identify 40, 50 companies which are doing consistently good, and then he will divide our money into those 50, 60 companies. So the large cap funds work in that way. So they invest only into the top 100 companies. Now, if you go to mid cap funds, as the name suggests, it is a smaller company as compared to large cap, just below it. So what are the mid cap funds? The funds which invest into companies which are amongst 101 to 250 by market cap size. Similarly, there is a small cap fund. Small cap funds invest into 251 to 500 by market cap size. And again, the percentage of each fund, how much it should invest into small cap companies or how much it should invest into large cap companies is defined. When we say large cap fund, if the fund is having a corpus of 1,000 crore or 100 crore, for a simple example, 80% of that fund should be invested into large cap companies. So if the fund size is 100 crore, out of that 80 crore, the fund manager will have to invest into large cap companies. Similar way in the mid cap fund, out of, if again same, if the AUM of that fund is around 100 crore, out of that the fund manager will have to invest around 65% money or 65 crore into a mid cap fund, mid cap companies. Similar way, as we the first three funds are very simple: large cap, mid cap, and small cap. There is no mixing in between. But if we go to a next category, that is a multi cap or flexi cap fund. In these funds, the fund manager has got a liberty to invest across market cap sizes. So based on the market situation, the fund manager invests some part of the money into large cap, some he parks into mid cap, and maybe he will give a small exposure to small cap funds as well. So that's how multi-cap and flexi-cap fund work. Sometimes based on the market situation, he might increase the exposure to large cap. At maybe other times, he might pair the exposure to large cap and increase the exposure to mid and small cap. So that is a fund manager's prerogative based on his study and his understanding of the market. He changes the exposure across the market cap sizes. Then there are focused funds which are investing into only 25 to 30 stocks. Generally, mutual fund invest into diversified companies. The number of companies held by a mutual fund could go into 60, 70, even at sometimes it is more than 100 as well. So what happens when you are investing into multiple companies, the risk gets reduced and still you are able to generate a decent return. But sometimes some investor might think that they don't want too much diversified approach and they want to go with a focused approach. They want to only invest their money into selected stocks. So in that case, they can go for a focused fund, which is investing only into 25 to 30 investment ideas. And therefore, the returns might be more as compared to diversified equity funds. But at the same time, since the number of stocks are lesser, even some of the stocks, like 2-3 stocks are not performing, it might affect the performance of the fund in a big way. It might take a big hit. So that needs to be kept in mind. Next fund is sectoral or thematic fund. So the first 5 funds what we saw, in this the fund manager is investing across the sectors. So it is not investing only into a banking and financial or only into real estate sector or only into energy sector. He is keeping his exposure diversified. The main purpose of mutual fund itself is a diversification. So to reduce the risk. Returns will come if you manage your risk properly. So you should not look at only returns. Simultaneously, you should also look at what are the risks involved while investing into equity. And by doing diversification, the fund manager generally tries to reduce the risk of the investors. But there are some investors who want to have a sectoral exposure. In last 2 years, you had seen sudden upside into the pharma sector because of this COVID. Lot of research was going on for finding out the vaccine, and many pharma companies ka stock were suddenly started performing very good. So there are some funds which are investing only into the pharma sector. So the investors who want to have a specific exposure to only a pharma sector companies can invest into a sector fund. Similarly, some investors might think the banking and financial will do good. So there are some funds which are investing only into the banking and financial services sector. Or maybe there is an infrastructure. Maybe in next 3-4 years, some might think the government is going to spend a lot of money on the infrastructure. So the companies which are going to benefit from this infrastructure push might do good. So there are some funds available which are investing specifically into the infrastructure segment. Those are called as thematic fund. So that way also you can invest. So you can find out whether there is any sector or specific thematic fund, and you can invest into that fund. Of course, again, as I said, in case of thematic or sectoral fund, the risk is the largest because you are only exposed to a particular sector. If that sector doesn't do good, the entire investment can go for a toss. In all the funds what we discussed till now, those don't give any tax benefit. Many a times you must have seen any of the investment, we first want to find out इसमें कुछ tax benefit है क्या. So the funds which we discussed till now don't have any tax benefit or Section 80C. But there are some mutual funds available. Those are called as equity linked savings scheme, in which if you invest, then the investment is locked for 3 years, but it also provides you tax benefit under Section 80C up to 1.5 lakhs. So there are equity linked saving scheme funds are also there. 1 minute. So from equity funds, we go to debt funds. Equity funds are majorly for the long term. As I said, if your investment horizon is more than 5 to 7 years, if you want to invest for a longer duration, then the equity funds are the right fit for you. But it may not be the case every time. Many times we want to park our funds just for maybe a 15 days ka period, or maybe a year or 2. So in that case, how do I invest? So then there are debt funds are also available, in which you can park your money even for 1 day. So if you see the name of the first fund, it is overnight fund. So overnight fund, in this, it invests into securities with a maturity of 1 day only. So instead of keeping the money into your savings bank, you can keep it into overnight funds or liquid funds. So liquid funds are invested into government securities with a maximum maturity of only 91 days. Similarly, as the maturity period increases, you will see there are ultra short duration funds which are invested into 3 to 6 months period. No duration funds which are suitable for investment of 6 to 12 months, short duration, medium duration, like that. Then there are corporate bond funds are also available. You must have heard about corporate FDs. Many of the private companies come with their corporate fixed deposits, like maybe Mahindra and Mahindra, HDFC Limited. So similar way, there are corporate bond funds are also available for investments. So only difference is that when you invest into a corporate FD, you are investing your entire money. So take for example, you have got 1 lakh rupees and you want to park that money for 1 year. So maybe after 1 year you need it for your higher studies or to pay your fees, or maybe a professional course fees. So you want to park that money for 1 year, you don't want to touch it for 1 year. So what is one option? One option is you can go and invest into a bank fixed deposits, which will offer you maybe around 4.5 to 5% right now. Or maybe you can go into a corporate fixed deposit of maybe HDFC Limited. So HDFC Limited might offer you a slightly higher rate of interest. But in this case, what will happen? Your entire 1 lakh will get invested into a one company ka corporate FD. And hypothetically, if tomorrow HDFC defaults, then your 1 lakh will be at stake. It will be at risk. So, as against that, what could be the other option? To invest into a corporate bond fund. So, here what happens? If you invest into a corporate bond fund, the 1 lakh doesn't get invested into a one company ka FD. It gets divided into multiple companies ka corporate bonds. So automatically, again, as I said, I'm saying it repeatedly, the risk will get reduced. So tomorrow, if one of those companies is HDFC, if it defaults, only the part of money will get affected, not the entire 1 lakh will be at stake. So that is the whole funda behind investment into mutual funds, diversification of the risk. Then there are last item is there are gilt funds which are investing into the government securities as well. So based on your requirement for after how many days you need the money or for how many days you want to park the money, you can identify the appropriate funds. Then the third category, as I said earlier, hybrid funds. As the name suggests, it is hybrid. That is, it is a mix of equity and debt. Equity gives you returns, debt gives you security. So what does hybrid fund do? It tries to give you best of both the worlds. So again, there are categories, subcategories into it. Aggressive hybrid fund in which the equity proportion is 65 to 80. So not 100%, but still it is major part of it is invested into equity and the rest is into debt securities. Then those who don't want such a high exposure to equity but also want some better return than debt funds can go for balanced hybrid funds or conservative hybrid funds, in which again the equity proportion is fixed from 40 to 60 or 10 to 25, like that. Sometimes in these first three categories, the equity proportion or debt proportion is fixed or it is varying in the narrow band of 10 to 15%, 10 to 25, 40 to 60, 65 to 80, like that. But what if you see a event like a corona, which was there in 2020, suddenly from the highs of 42, market came down to 26, and suddenly there was a big opportunity to invest into equity. But if there would have been a conservative hybrid fund, what it would have done? It would have only increased its equity proportion from 10 to 25 because the fund design is like that. It cannot invest more than 25% into equity at any point of time. But you want to take benefit of the sudden fall as well. Then maybe you can go with a balance advantage or dynamic asset allocation funds. So as the name suggests, what it does, it dynamically manages the asset allocation based on the market situation between equity and debt. So when the market is down, it will increase its allocation to equity. When market goes up or market becomes very pricey, then it might reduce its equity exposure and go down into the debt and park its money into debt for a safety. So that way balance advantage funds work or dynamic asset allocation funds work. Then there are multi-asset allocation funds as well. As I said earlier, it is not only equity and debt, but there are some funds which are also invested into gold or international equity. You might have heard before that all the asset classes don't perform at one go. When equity is performing good, gold might not be performing. Or at some point of time when US market is doing good, Indian equity market is lagging behind. So if we have got entire investments into only one category or only one asset class, then we run a risk of concentration. So multi-asset funds, what they do, they diversify your investment into multiple asset classes. So at all point of time, you will get a decent return. You may not get super returns kind of thing, like you might get into pure equity funds, but there won't be any issues of the performance at when the market is down or when all the asset classes are down, because one of the asset class will always do good, and then it will help the multi-asset allocation funds. Then the last part of it is arbitrage funds are also there, which take the benefit of the arbitrage between that is the rate variance between the two markets, that is National Stock Exchange and Bombay Stock Exchange. As I have been discussing quite in detail about the risk and return, risk. So what is the risk return trade-off? So if you see in debt funds, we run a risk of on three items. One is interest rate risk. Recently, you must have heard the RBI kept the rate stationary, that repo rate and reverse repo rate were not changed. But if the rates were changed, then that interest rate ka risk will be there on the debt funds as well. Then what is the second risk? Second risk is the credit risk. So as debt funds are investing into different corporate bonds or government bond papers, there could be a credit risk that some of the papers might default. And if that paper default, then it might reflect into their investment portfolio. And the last risk in debt funds is inflation risk. Debt funds are not for the return, debt funds are for safety. So it does not beat the inflation in the long term. So debt funds is only suitable for saving. It is not good investment option for long term goals. And similar way, when we go to equity funds, what is the risk we get? It is a volatility risk. The risk, the funds don't perform in a linear fashion. When I say in long term you might get 12% annualized rate of return, it doesn't mean that every year the returns will be 12%. It might happen 1 year the return might be minus 50, next year it might be 200%, or maybe for 3-4 years it might be in the range of 5-6-8%. But when you invest for a long term, that returns are normalized and you get a return in the range of around 10-15%. So that volatility risk is a major risk in the equity funds, and that you need to be aware of. Second risk is the management risk. So when I say management risk, it is again each individual fund is managed by a fund manager. The fund manager is managing that fund based on some rules or based on some strategy which is devised by him or the asset management company. So sometimes the management calls of those respective fund manager doesn't go correct. So in that case, the equity funds might underperform vis-a-vis the market. So that management risk is there. And then the liquidity risk. Suddenly it might happen when you want the money, at that time the market has gone down. So in that case, the valuation might be a stretch valuation. You might not get the value which you had seen just the last week. So that liquidity risk is always there in the equity funds. So against risk and return, how the different categories of the funds are ranked. So that I have tried to show in this graph. So if you say a risk return spectrum of if you see the risk return spectrum of debt funds, so what is the least riskier fund? As the name it is shown over here, it is overnight fund. In this overnight fund, since the fund is investing only into the papers which is getting matured in one day, it has got the least risk of default. So overnight funds are the least riskier funds, but at the same time, it gives you the least returns. If we go up in the ladder, then you see liquid funds, ultra short duration funds, low duration fund, like that. Corporate bond funds are there. And then on the upper side of it, there are gilt 10-year funds or long duration funds. If we come to a similar way, the graph for equity funds is like that. As I said earlier, the large cap funds are comparatively the lesser riskier funds, because these big companies are not going to default or not going to falter. Maybe their performance might get affected because of the external factors, but the company ka fundamentals are very strong, and they are available for in open market for everybody to see. So that is why the large cap funds are generally the least riskier, but at the same time there is the returns will be lesser as compared to the other funds. And as we go up on this graph, we see large and mid cap funds, multi cap fund, diversified, dividend yield funds, ELSS, that is tax saving fund, focused fund, mid cap fund, small cap, and the highest riskier funds are sectoral or thematic funds. So in sector or thematic funds, generally you need to they perform in cycles. Their cycle may be 3 or 4 year cycle, during which they will perform good, then they will go down again, maybe 3-4 years ka downside will be there, again they might come up. So the sector and thematic funds are cyclical funds, whereas the large or mid, small cap, multi cap funds are for longer tenure funds, longer tenure investments. So now that we have known the types of mutual funds, what are the investment options into it? So one of the famous investment option is systematic investment plan. So what is a systematic investment plan? As the name suggests, it is very simple, intelligent and practical way of investing into the mutual funds. Why it is simple? Because you can start with a minimum investment of only 500 rupees per month. Even if you have 500 rupees per month available with you, you can invest into mutual funds and start your investment journey. Second is, it is intelligent. So why it is intelligent? Because it is benefiting from the power of compounding. How it is benefiting from power of compounding, that I will show you with an example. Third is very practical. You can link it to your financial goal and then start straight away. So for every investment, if it is attached to a purpose, there are high likely chances that you will stick to your investment plan and you can achieve your goal. As the last line is mentioned here, a long journey begins with a small step. So it need not be always thought of that I will have a big money and then only I will start a big bang way in equity market. No, you can start with your small investment amounts as well, as small as rupees 500. So what are the features of systematic investment plan? So as I said, you can choose it is a systematic investment plan of mutual fund is a very flexible investment option. Why it is so? Because one thing, you can choose any date for systematic investment plan. You can start from any date in a month. Second, whenever we are starting any investment, we have some jitters in our mind. What if I am not able to continue with this investment? So SIP, you can stop anytime. It doesn't penalize you for stopping the investment in between. Third, you can stop now that you have stopped the investment. It need not be that you need to withdraw it only. You can keep your investment. Like I'll give you an example. One of the students, actually he was from the last batch only. He started his investment. We started with I think 1,000 rupees a month last year. And at that time he was doing a part-time job. So we started with 1,000 rupees investment. He was teaching at some classes, I believe. So we started with 1,000 rupees ka SIP, and for his graduation exam, he had to take a break of 2-3 months for studies. So what did he do? He requested me that, sir, I cannot continue with my 1,000 rupees SIP because now there is a break in my college studies because of the college studies, and I'm not teaching it at the professional institutions. So I said, fine, not a problem. You can stop your SIP. But then he said, sir, but what will happen to the investment which I have done till now? I said, let it be. It won't get affected. It is not since you have stopped the investment, you need to remove your investment. You can keep it there. It will continue to grow. He said, okay, sir, that is great news. So I'll restart my investment after I complete I give my examinations. And he did it. After 3 months, we again re-registered his SIP, and then the investment started. And whatever investment he had done earlier, that remained there and it continued to grow. So you can stop your SIP and let your investment grow. You can redeem your SIP anytime. Again, you can, whenever you want money, you can redeem it. Again, if you want, it need not be entire money, need not be redeemed. If you have started a 1,000 rupees SIP, you have invested for 1 year, it has become, investment value has become 12,000. That 12,000 because of the market return has become 13,000. Out of that, if you need 5,000, you can remove 5,000 only, and you can continue with your investments. You can increase or decrease your SIP. You have started with 1,000 rupees, but you got some second income started coming, so you want to increase from 1,000 to 2,000. You can do it. So from 1,000 rupees SIP, after maybe 6 months or 1 year, you can increase it to 2,000. After maybe again 6 months, you want to decrease it to 1,000. That is also possible. And as I said, the last point, you can invest any amount. The minimum amount starts with a 500 rupees. So what are the benefits? Basically, the systematic investment plan, as the name says, it is a systematic investment plan. So it helps you set aside a fixed amount every month for the investment. It automatically inculcates a discipline in your life. There is no need to wait to collect a large amount of money to invest all at once. So you can start with a small amount. As your income starts growing, you can increase that investment gradually. So that can be done. It imparts a financial discipline, as I said. Invest irrespective of the market conditions. Many times when you are investing into the stock market, you get swayed by the market news. When the market is high, everybody wants to invest. When the market is low, you want to take out the money or you want to wait. But believe me, it is not possible to time the market. So many times it happens that people who were waiting on the sidelines for market to correct could not enter it when it was down, and they just kept at it watching it went up from 26 to 62,000. So what does the SIP do? It helps you invest irrespective of the market conditions, because every month a fixed sum of money is getting deducted from your bank account and is getting invested. So you need not time the market. The next advantage is rupee cost averaging, helps neutralize the market volatility. Because you are investing at all point of time, your investment averages out, and again it neutralizes the market volatility, and it helps you gain good returns in the get benefit of the power of compounding. And the last point, which is most important, that it helps you achieve your financial goals and create the wealth over long term. So whatever investment that you are doing, you should first assign a financial goal to it. Just don't start investing without any goal in mind. Whenever you are studying, just apply it like your professional, rather your educational life. When you are studying right now, maybe most of you might be doing BCom, but you must have set a goal that I want to maybe do a MCom, or I want to do a MBA, or some other professional thing, or some of you might be planning to go to a CA. So it is not कि you are just taken the admission to college and कुछ करना नहीं था तो college में गए, ऐसे नहीं होता. Everybody has got a purpose, has got a defined goal to whatever actions that you are taking. In a similar way, for your financial life, set a financial goal and start investment towards it. Then only it will happen, and then only you will be able to set aside a sizable money and you'll be able to achieve your goals. So I was telling you the power of compounding. So how does the power of compounding helps in the long run? No? That is shown here in a table. So take for example, if you are investing around 10,000 rupees a month. So if you invest for 5 years, that 10,000 rupees, obviously that 10,000 into 12 into 5, it will become 6 lakhs. Now just assume that investment of 6 lakhs or that investment into mutual funds gives you a return of around 12%. I'm taking a 12% because in the long run we can safely assume returns from the mutual fund in the range of 12 to 15%. But to be on the conservative side or the calculation purpose, I'm assuming 12% returns. Now if you see, if you invest 6 lakhs in 5 years and if the investment grows at even at 12%, the corpus is growing to 8 lakhs. So what is the difference between the investment money and the corpus? It is only 2 lakhs, 8 lakh 11 minus 6 lakhs. So even after 5 years of investment, even after the investment growing at a 12% year on year for 5 years, the corpus has grown by only 2 lakhs. But if you are patient, if you have defined goal, and you kept on investing the 10,000 rupees for maybe 10 years, now your invested amount has grown by only 6 lakhs. But see what is the value of that investment. From 8 lakhs, it has become 22 lakhs. So what is the difference now? 22 minus 12. So the difference which was earlier only 2 lakhs, that gap has widened, and now the difference is around 10 lakhs. Now from 10 years go to 20 years, that your investment value has grown from 12 lakhs to 24 lakhs. But see on the right side, the 22 lakhs now have become 91, 92 lakhs. So investment amount has doubled, but the rate of, because of the higher rate of return and the power of compounding, the investment value of that investment has grown to 4 times. So that is the power of compounding. So if you remain invested for the longer time, it will really make a difference to your financial life. But for that you have to be patient, and you have to be disciplined. You have to be focused. Don't go by the sudden spike in prices in the stocks. It might give you a short-term pleasure, but maybe in the long run, you will be there only. There won't be any change in financial life unless and until you invest for a long term. Just take an example. Mukesh Ambani, he is the owner of Reliance Industries. He is owning the shares since last 40, 50 years. Has he sold his stake in Reliance Industries? No. Because he knows his company is going to grow, and from that his earning is going to get a dividend and appreciation in the prices. That is why he is the richest person in India, or one of the richest person in the world. He hasn't become rich by buying and selling of the stocks. So that way the compounding helps you to earn the returns on your investment and become wealthier. So now we have seen only the systematic investment plan. What is systematic investment plan? That is, from your bank account, you are investing a fixed sum of money into the mutual funds. So what are the other ways of investment into the mutual fund? One is systematic transfer plan, and second is systematic withdrawal plan. So what is the difference between it? So that I have tried to explain in a simple images. As I said, in SIP, the money goes from your bank account and it invested into the mutual funds. So what is the systematic transfer plan? Sometimes what happens, you have got a big sum of money, but you don't want to invest entire money at one go into mutual funds. So then maybe you can take a systematic transfer plan route to invest into the mutual funds, that you will park your money into the debt mutual funds, and systematically you will invest a part of that money into the equity mutual fund or the destination fund which you have decided. So you are not investing entire money at one go into the equity markets. So STP helps you in that front. Systematically the amount is invested into the mutual funds. And the last part, which is systematic withdrawal plan. Basically that systematic withdrawal plans is a option which is used by the retirees, or the people who have retired and they want a regular income from the mutual funds. So just understand, in your case, you will be building a portfolio so that in next 20, 25, 30 years, you will have a big corpus which you can utilize for your future plans. Whereas systematic withdrawal plan, what happens? The people who have already have a big corpus, they want a fixed income, like a pension from their investments. So they use systematic withdrawal plan. So they invest into mutual funds, and then every month they withdraw some fixed amount, which is sent to their bank account. So this is another option of investing into mutual fund and getting a regular income, mostly utilized by the retirees. Again, as I said earlier, systematic investment plan, SIP, is a good tool for goal-based SIPs. So what are the different goals we can think of maybe a short-term goal, a medium-term goal, and a long-term goal. So when we say short, medium, long, it is generally defined by a period. So what is a short-term goal? When the goal is only 1 to 3 years away, it can be called as a short-term goal. Can anybody tell me what could be a short-term goal for you, Amruta? I just want few answers from the participants. So when we say a short-term goal, what type of goal comes to your mind, for which you would like to keep aside some money? You want to you will invest some money for your short-term goal. What it could be? Participants, any answers?
Small amount of time, as Karishma says.
Pardon? Can you come again?
Small amount of time, Karishma has said that.
No, actually, I want to know goal. What could be a short-term goal for which you would like to invest some money for? Any purchase?
Is
Any
saying
capital item?
laptop.
Correct. Laptop could be a short-term goal. The famous thing which hasn't come. Anybody planning for iPhone?
Archita says vehicles.
What she's saying?
Vehicles.
Okay.
Even
So short. Yeah. Go on.
hello, Karishma has said mobile phones.
Exactly. So short-term goal could be a new iPhone. Boys might want to have a new bike, a treat for no reason. For there could be n number of reasons for giving treats to friends, or there could be a road trip plan as well, like going to Leh Ladakh. That could be a goal. As soon as after completing maybe your graduation, some of you might be planning a road trip on a bullet. So that could be one of the short-term goals. Then if we come to medium term, when I say medium term, it is 3 to 7 year goal. So any options on the medium term goal? What are your medium term targets? When I say where do you see after 3 to 7 years, where do you see yourself? What you would be doing? Many of you might be completing your graduation by that time. So what could be the next goal in a medium term goal?
As Janvi says, completing a degree.
Correct. And maybe going for higher studies.
Having a luxurious life, as Archita says, with hard work of job.
Okay.
Then Karishma says going for higher studies.
Correct. So medium term mein generally the post graduation, as most of you have correctly said, going for higher studies, post graduation, MS, doing MS in maybe US or some foreign university, that could be a medium term goal. Or maybe some of you might be planning to buy a new car after immediately starting your job, or it could be a foreign trip. So that could be a medium term goal. And then the long term goal. When long term goal, the obvious answer which comes to my mind is a retirement goal. But apart from that also, there could be other long term goals. What it could be? Some answers, please.
Real estate, as Prajapati says, new house, Vishal has
Correct.
said it. Then
Correct.
business,
Correct.
Karishma has said that.
Yeah, Karishma is giving a lot of correct answers. Huh? I must appreciate. So long-term goals could be buying a home, as some of you said. As you get stabilized in your career, then obviously everybody wants to have their own home. Obviously, that entire home price you cannot entire home cannot be bought through your own funds, but you will obviously go for a loan. But your own contribution you can keep aside, and that you can build through a long-term SIP. Similarly, starting a family at that time also you want to plan for your children. Mid-year career upgrade, that is one of the major major goals for which most of the people have started investments. So as you grow older into an organization, your present education and your present qualification and your present skills may not be sufficient for you to keep abreast. You need to keep abreast. It may not be sufficient over a longer period of time. So many of the people go for a mid-career upgrade for some additional qualification, and those courses could be quite costly. So again, planning for those goals can be done through systematic investment plans. Many a times, because as I said initially, because of the work pressure, suddenly some people take a sabbatical. That is quite prevalent in female lives. So during the children, when they are into their adolescent ages, uh, the female from the family takes a 1 or 2 year break. So during that sabbatical break, how the funds will be coming? Obviously, when you are taking sabbatical, there is no income. So during that period, if she wants to have her own, but she's used to some kind of life, uh, having a free flow of money available at her disposal. But when you take a sabbatical, that money isn't available. So how can you plan for it? You can have a corpus built for your sabbatical. And then the last part of it is obviously early retirement or financial freedom. So if these create funds, so whatever we have learned or we have gone through till now, can you tell me what could be a appropriate goal, appropriate fund for the short term requirement? I don't want a specific fund name. What would be the category of the fund which is appropriate for the short term? We have seen 5 categories of the funds: equity, debt, hybrid, solution oriented, and other. So what do you think could be an appropriate goal for a short term requirement? Can I get some answers again? Will you go for equity fund for short term, or will you go for debt funds for the short term?
As Sir Jani is saying, debt funds.
Good, Janavi. So for short term, you will go for debt funds, because debt funds will give you safety. In short term, you don't want to lose the capital. You just want to keep aside some money. So in that case, the debt funds will come in handy. So for short term, it will be debt funds. And again, in that debt fund, there could be n number of funds. So based on the advice and your own requirements, you can select a proper kind of debt fund. Then similarly, in a medium term, when we are saying 3 to 7 years, what could be the obvious choice? If we are using debt funds for the short term, for medium term, what type of funds will be appropriate? Any guesses? Amruta, you tell me now. Will you go for equity funds, or will you go for again debt funds, or will it be hybrid funds? Hello. Hello, hi Amruta. Any answers?
Audible?
Hello.
Sir.
For
Hello,
medium
sir.
term, what
Am I
kind of funds will
audible?
be? Yes, you are audible.
As Vishal is saying, it's hybrid, and Prajapati
Uh,
is saying both equity and debt.
Exactly. For medium term, it will be a debt fund or a hybrid equity fund, because on the lower side of it, it is only 3 years. So maybe you can go for a debt fund, or it could be a mix of debt and hybrid equity funds. And then the obvious choice for long term, it will be equity funds. It is a no brainer. When it is beyond 7 years, obviously you want returns from your investment. The safety is automatically inbuilt into it when you are investing for the longer duration. So you should go for equity funds for the long term. So that is a broad classification and how it is linked with the your goal based investments. So I'll just summarize it what we have learned today. First is new generation financial challenges. As we saw, your study age is increasing, your life expectancy is increasing, but your working life is reducing. So we have got very limited period of time to achieve our financial goals. So in this reduced working life, what is the best option to invest into? It is a mutual fund, which is a trust that pools in investors' money, sharing a common financial goal. Mutual fund, as I said, it is an all seasons product having scheme for all types of investors, all asset classes, all 10 years risk and goals. It is you need to be aware of, and you need to first identify what is your requirement, and then there are funds available for each and every requirement. It is a tax efficient investment option. There are tax saving mutual funds mutual funds also available, and in the long term, equity as well as debt funds have very tax friendly structure. Uh, then, what is a easier investment option to invest into the mutual fund is systematic investment plan. It benefits the investors over long term from the power of compounding. As I showed you from the table, even a small investment of 10,000 can give you a lot of money over a period of time. So, what is the correct way? That first you identify your goals for what you want to start the investment. Categorize them into short, medium, and long term, and then choose the appropriate mutual fund scheme for each of those goals. And the last, but the most important point of it is consult a trusted advisor and begin your journey of wealth creation. In all these things, if you face any problem or any issues or you need any clarity, then you consult an advisor, and then you start your investment journey. It may be with a small amount, but start. Taking a start is a very important thing. Once you start it, then automatically you will increase it in future. But the starting is very important. That first step is the most important step in your investment journey. So I'm ending my presentation again with a quote of Warren Buffett. What he says: to be successful in the market, we don't have to be smarter than the rest. We have to be more disciplined than the rest. So the crux of the matter doesn't lie in selecting the winning stock or winning funds. What is important is identifying the goal, identify the amount that is available with you, decide the duration of the investment, and invest in a disciplined manner. If you do that consistently, you will easily achieve your goal. It need not be that you need to find a diamond from the that stock mine. That this only one stock will take me to the will make me rich. This won't happen, because it is very difficult to find out a diamond, and again that diamond will remain a diamond over a period of time. That also we don't know. But what is in our hand? Identifying the goal, starting your investment, and be disciplined than the rest. That is in our hand. If you do that more consistently, then you will be able to achieve your goals through mutual funds. So happy investing. Thank you. That ends my presentation, and the forum is open for question and answers.
Thank you, sir, for giving us such a wonderful session. The session is now open for question and answers. You may ask your question by typing it in the chat box. You may unmute yourself. Anybody has any queries, you may ask by typing in the chat box. So there is one question. Could you please explain the solution oriented and short?
Amey, solution oriented, as I said, there are major two solution oriented funds are there. One is retirement fund and one is children gift fund. So in case of children gift fund, the investment is done in the child's name. So take for example, a newborn baby is there, 1 year old. Then you can start an investment in his or her name. And till he or she turns 18, the investment cannot be withdrawn. Once the child turns 18, then the investment is again changed to from minor to major, and the maturity amount or the value of that investment is credited to his or her bank account. So that's the way children mutual funds work. Similar way, in a retirement fund, it is specifically for a retirement goal. In retirement, there are two things are there. One is you start building a corpus for your retirement. So these retirement funds help you building that corpus. And the second part of the retirement fund is distribution phase, wherein whatever the corpus that you have built till retirement, you start using it or you start withdrawing it as a pension for your post-retirement life. So the retirement funds help you build that corpus. And since it is for your retirement, like your equity-linked savings scheme funds, you get a tax saving benefit if you invest into retirement funds. Janavi is saying, can you please explain in short about hybrid funds? Hybrid fund, as I said, it is a mix of equity and debt. Sometimes people don't want to have a high risk investment, so they don't want to expose their entire investment into equity. So that time those investors can invest into hybrid funds, which doesn't have entire exposure to equity. The exposure to equity ranges from 25 to 80%. So based on the individual's risk profiling, investors' risk profiling, we can choose an appropriate fund, and the returns will vary according. Returns will vary, of course, according to the risk proposition. If it is a conservative hybrid equity fund, then obviously the risk will be lesser because equity proportion will only be maybe 25% or so. But returns will also be lesser. But many times, what I have seen, some people, especially the people in the senior citizen category or the older category, they don't want big returns. They want safety. They want less volatility. So even if they don't get 15% return, they are quite happy. They will say, "Ki I am okay with around 10% return also, but the volatility, the price fluctuation should be lesser, because that gives them a lot of pressure." So nobody wants to see their investment value becoming lesser, suddenly lesser next day by 3 or 4% because of the market fall. Nobody wants to see that. So basically, those kind of investors prefer the hybrid equity funds, in which the volatility is lesser, and they are happy with their lesser returns as well. As long as they are getting good returns as compared to bank FD, they are happy. So for those investors, hybrid equity funds are suggested. Or even as I was explaining about the your medium term education goal. Now just assume that you or maybe your parents also, if your parents are investing for your post graduation studies, at that time obviously they will require returns, but more than that, they will also look at the safety aspect of it. They cannot tell you, no, because of the market downfall, the investment value is lesser, so you cannot go to IIM Ahmedabad. You go to Chetna. That cannot happen. So if you are aspiring for IIM Ahmedabad, you are studying so much, obviously you will need that money that year itself. If you are your GRE score is good, you want to go outside India, so you are getting admission, so you want to go that year itself. That goal cannot be postponed. So at that time, the more than returns risk is takes the what we say is prominent. So you want to reduce the risk. At that time, you will go with the hybrid fund. You won't go with the equity fund. So again, that based on your goal and risk return trade-off, you need to decide which kind of funds are suitable for you.
So there is one more question by Pratik. What is your viewpoint regarding NFTs comparing with mutual funds and NFTs?
Can you say again? I could not hear you actually properly.
What is your
Sorry.
viewpoint?
What is your viewpoint regarding NFTs comparing with MF and NFTs? NFTs mean I did not get you. What is NFTs?
So it's a non-fungible token.
Sorry, Pratik, I am not aware of it.
All right, understood.
Anybody has any other questions? Anybody has any other doubts? Okay, so thank you, sir, for giving us such a wonderful advice and for giving your valuable time to us. The session was indeed very informative and thought-provoking. I would also like to thank our sponsors, title sponsors, Phoenix Financial Services, prime sponsors, Flavors of China, and Sai Shraddha Enterprises, associate sponsors, Vishnu Creation and Mukmar, souvenir sponsors, Zoshi and Associates, Vikri, Amul Cardpoint, and Pooja Enterprises, refreshment partners, Sisters Creation, and Nirja Enterprises, media partners, Maharashtra Time and Rashtra Time. Thank you so much. Participants, you may leave the meet. Thank you so much.
Thank you, Amruta. Bye.
Thank you
If
so
you have
much,
any
sir.
doubts, you can get my contact number from the Udyojak team.
Yes, sir, definitely.
उन्नत शिरमन कृतज्ञ आमचे उन्नत शिरमन कृतज्ञ आमचे भाग्यवंत